I want to bring in Greg Branch, the managing partner at Veritas Financial Group, also a CNBC contributor. Get your sense on these inflation numbers, and are you surprised by the way the market's taking them?
I'm not necessarily surprised, Andrew. At the end of the day, the market has been hoping, and Joe referenced this earlier, we see this in the Fed funds futures rates, we see this in the 10-year and the 2-year. The market has been anticipating some type of pivot. The market has been anticipating some type of relaxation or at least pause by the Fed, and we're just not there yet. What will rightfully grab headlines is that on a year-over-year basis, the number came down, but probably more importantly, when you look over a month-over-month basis, it's likely to have gone up about 20 basis points. And so as long as that number is still increasing, we can look for comfort in saying that the year-over-year went down, but that probably ignores the base effect and that we're lapping some pretty difficult compares as we go forward.
So what are you doing about it? And what do you think viewers should be doing about it?
I think you'll be shocked, Andrew. I actually looked to be more bullish when I did my year-end lookout, and I looked across 2023 and tried to write down my expectations. I actually started to get very bullish about the fourth quarter in particular. I think we lapped some very easy compares, particularly with some of the technology companies where ad spending fell off, et cetera. I felt that analyst estimates, which are still a problem, they're still too high, Andrew. I thought that when we reach kind of mid-yearish, that we will have gotten the expectations in line with what we're likely to see. And I thought that we'd be past the Fed and looking to the Fed for all of our market movements. I'm now less optimistic about those scenarios. One of them we also touched upon earlier, that we are now 425 basis points into a rate hike cycle, and yet we still have unemployment at 3.5%. Remember, the Fed is targeting 4.5%, if not more, to get that wage inflation under control, which is the primary driver of services inflation. And if there's going to be a duration between when the Fed acts and when we actually see that play out, when we get the desired results in the market, that means this is going to be with us for a while longer than we expected.
But I think part of the question is, I think we know what the Fed's going to do in the near term. The real question to me is what you think the Fed's going to do next fall. And I know that's sort of maybe we're looking too far out, but that's basically what people are betting on, one way or the other at this point.
No, I don't think it is looking too far, Andrew. And I think that's why you hear a lot of folks now subscribing to higher for longer. Their higher is probably less than my higher. Remember, I'm on record as saying I think the terminal rate will likely end up being somewhere around 6%. But I think we'll be in that range for a couple of years.
Say
and if
that
that's
again?
the case,
what do you think the terminal rate is? What did you?
6%.